over the last 12 months, Palantir has had some phenomenal performance, up 61%. And today we are going to do a deep dive getting to our own valuation of this company. As always, we are going to take a look at some of the underlying metrics from this company, their free cash flow growth, their sales growth, but we also want to incorporate what are insiders doing. We are seeing quite a lot of selling over the more recent quarters, but what are also the institutions? Is there any themes or patterns that we can start to see? Any trends that will give us an advantage? We'll also pull a few slides from their latest investor presentation just to keep you up to date on their very strong growth. And as always, we will highlight how this company has been growing very rapidly, not just on their revenues and their bottom line, but also taking a look at the health of this company, their total cash versus their total debt. And always, one of the most important parts, we are going to run it through the valuation model, getting to what we see as the intrinsic value, what is our acceptable buy price given our investor margin of safety, and what also Wall Street see over the next 12 months. Also to see what is the price this company would be trading at if it does meet a 1 trillion market cap company. And as always, in detail with our valuation, we're going to go to a low, medium and high grade so you can also understand where our future projections are coming from, whether or not you agree, and also to see what maybe you would believe this company is worth over the next 12 months. So let's just remind ourselves of this company, a few facts. We do have a buy rating from Seeking Alpha, a double hold from Wall Street and Quant. We can see a forward P of 78.22, but as always, we will look at the numbers behind that to see if that is justified and warranted. And when we do take a look at this company, in terms of their top line revenue growth, well, it has been very strong just over the last 6 years, typically 3 to 7%, but remember, this isn't a typical company. 600 million they've reported on their top line revenue in 2018, 2.2 billion in 2023, and what I'd love to see on a graphical basis is that consistent, very strong growth year on year, and we will come towards looking at that growth on a percentage format as well. Bottom line, well, a very interesting thing here to note, they were making a net loss over the last 5 years. However, their latest annual accounts, 2023, does show the first year of a net profit, and hopefully that will continue. In fact, on a trailing 12-month basis, we already see it up around 50%. In terms of graphical as well, we can see that very clear here. 5 of those 6 years negative, more recent positive. Now, in terms of the health of the company, very important, always include that in your analysis. Total cash versus total debt, well, 1.1 billion of cash and short-term investments in 2018, 3.9 billion in that latest quarterly report. Similar to their top line revenue, they have been stacking the cash over the last 6 years. But as always, in isolation, this number doesn't mean anything, which is why we always add that review level of comparing it against the total debt, numerically and directionally. Well, they had no total debt in 2018. The latest quarterly report showing 217 million, so it wouldn't even take them 1 day to pay off all of that debt net of cash on hand. And we can see here, in fact, their total debt has been decreasing over the last few years. So bulletproof balance sheet, and the numbers on the top line revenue growth are looking very strong. One thing we always like to do is compare their historical performance to give us confidence moving forwards. Well, over the last 4 quarters, they have at least been in line with management estimates and analyst targets. They have beaten once, although very marginally. This does give me pretty much very strong confidence then, whatever they set out to hit over the next few quarters, that they should be near enough within that. And what we do notice, 61%, so double-digit growth expected year on year on the EPS next quarter. Again, double-digit into Q3 with a high single-digit in Q4. Now, if they do hit their December 2025 earnings per share estimate, we do see that forward P come down to around 65. But as always, we need to understand whether or not it is even warranted for this to be a very high number. So great news here then, they have at least over the last 4 quarters been in line with analyst targets. So moving on then towards essentially looking at some of the underlying metrics and some gradings. First one we want to look at valuation. Well, they get an F, no surprises there. In terms of the P on a non-GAAP basis, 78.22. Now bear in mind the sector median is trading a lot lower at 23.78. But one thing that we always need to understand, there could be reasons which we will take a look at and see whether or not it's justifiable through their growth, through their profitability, as well as others. One thing is clear though from this essential metric valuation is that on every single valuation that you look at, whether it's the price to sales, the EV to sales, they are trading at a significant premium to the market. Now, in terms of the growth grade, well, they get an A. Some of the reasons for that: year-on-year revenue growth, 17.6%, sector median low single digit. On a forward-looking basis, 19% anticipated, again, mid-single digit for the sector as a whole. And when we do come and look at something that I quite like to see, the earnings per share anticipation over the next 3 to 5 years, 24% year-on-year is anticipated, and as we can see, sector median 14%. So again, there are other metrics here that if you do want to see, but overall on the growth, they do get an A. We then move on to the profitability, an A-. So again, very strong to see their gross profit margin, 81%. Sector median, 49%, net income margin, 12.8%, and we can see again sector median, 2.83%. Finally, one of the things we also like to point out, cash from operations, 655 million versus 90 million from the sector. So overall, in terms of growth and profitability, looking very, very strong. It is whether or not you can wrap your head around that valuation. And a little conclusion for this part of the analysis: a buy rating from Seeking Alpha, a double hold from the other two, an F on the valuation, an A on the growth, and an A- on the profitability. Now, in terms of this industry, how do other companies compare in the application software? We have Workday, Roper Technologies, Autodesk, as well as a few others. Well, over the last 12 months, we do see Palantir the best performing, up 62%. Although when we do extend that over the last 3 years, we do see them second best, but we can see in fact 0.51%. So depending on when you did invest in this company, but the main point really that we want to reiterate here, regardless whether you've bought it over the shorter or longer term, past performance of a company is not indicative of their future performance, but always we do like to see how they have performed against the sector and if there are any trends that we can see. Then moving on to something that I find very, very important. Sometimes people do skip this part of the analysis. Ask yourself 2 questions. 1, has it historically outperformed the S&P? With Palantir, over the last 12 months, yes, 64% versus the S&P 25. When we expand it over the last 5 years, the answer is no. Now, that is a bit of a mix, so yes, over the shorter term, over the longer term, 3 years, it isn't. And the second question to ask is, do you believe over the longer term it will outperform the S&P? If the answer realistically is no, or you're not too confident, why bother with that risk when you could just invest in the S&P low-cost ETF like Vogue? Now, before we jump into some of the metrics, we just want to point out 2 things here. Firstly, 11 insiders have sold over the last 12 months, and insider ownership is fairly high for Palantir, around 13%, around $493 million worth of selling. In fact, Q2, the latest quarter, $240 million. Q1 184, and when we do come to see who these insiders are, well, we see the director on the 12th of June, so just last week, sell 3,000 shares. Not a very large amount, as we can see here, $72,000. In fact, if we do want to see one of the larger sales, we would have to look to around the 10th of June, as we can see 20,000 shares. Just before that, another tranche as well, 26,000. Now, whether or not you do believe this is a bearish signal, as always, information is there. For me personally, we don't know why they sell, personal financial reasons, so I wouldn't really use this as part of the thesis, but again, information is there. In terms of institutional ownership, 682 million worth of sales by the institutions over the last 12 months, significant amount more buying, 7.51 billion to be exact, and that is also in the more recent quarter, 533 versus 197 million. So as always, institutions have been buying more, not just over the last 12 months, but also over the more recent quarter, and in fact over the last 4 quarters as well. Now, whether or not you include this in your investment piece, don't invest solely off of this. Always do your own due diligence. Though we can see institutions very bullish, they have been buying. Insiders, on the other hand, have been selling. Now, just to let you know, we have released our latest free weekly article. If you want access to this or any other articles, all completely free, do click on the pinned comment below. A lot of people ask, what are the websites, resources, screeners that we use? This article does explain all of that. And for those that want to see 12 undervalued stocks, high quality, again, we have released an article a couple weeks ago explaining those that we do see now. So let's jump into the latest investor presentation just from a few weeks ago. Few things we want to highlight. In fact, the Q1 2024 highlight that we will draw out. Firstly, revenue growth double digits, so 21% year on year, around 4% on a quarter-to-quarter basis. They have closed a significant number of deals, in fact 87 over 1 million, and again, a lot of this information we will come onto, but lots of positives from that latest investor presentation that they did run through with all of their numbers. First thing to note, they have been awarded a lot of contracts. In fact, one of them was by the US Army for over $178 million. Since then, they have also been awarded a lot more contracts as well. It does seem like there is a lot of bullish news around this company on a day-to-day basis. Second thing to point here is that they have achieved GAAP profitability for the 6th consecutive quarter. The reason why this is important because when we did look at those numbers on the bottom line net income, we did in fact see quite clearly that they were making a loss for the last 5 years, other than their more recent year, 2023. So this is a very bullish signal. It does mean that that growth on that bottom line net income will continue and it will be a profit as opposed to a loss. Second thing that we want to just highlight here, from Q1 23 to Q1 24, their total revenue is up double digit, 21%, always great to see, and 4% on a quarter-to-quarter basis. When we take a look at this company, remember with any company that we want to review on this channel, top line revenue and their margins, two key metrics that we do want to see an increase. That does show a lot of strong operational efficiency, something that we have seen here with Palantir on a quarter-by-quarter basis, going from 24% in the same quarter in 23 to 36% in the same quarter in 24. Finally, as we did mention earlier, they've closed 87 deals of at least $1 million, and in fact 27 of those were at least $5 million. 15 of those were at least 10 million. As we said, they are closing more and more contracts as we speak. So lots of great news, lots of bullish, but as always, valuation is important, which we will come on to. Free cash flow, again, very important for me as opposed to earnings data, which is susceptible to manipulation by management through accounting. 3 years, 2018 to 2020, it was negative. Since then, though, it has gone positive, and 23 at 32 cents is expected to be increased into 2024, although marginally to around 34 cents. We then move on to the sales growth. One of the key things with companies that grow is the expectation they will slow down. We can clearly see this from their numbers. In 2020, it peaked at 47%. 2023 at 17%, so it is starting to come down. Something just to factor in when you are looking at this company and you are drawing your expectations for the future, whether or not you will see that double-digit increase continue for at least the next 5 years. Total sales then, this is just what we saw earlier, but a different variation to see. And shares outstanding, important to understand, they would have diluted your position as a shareholder, and it does continue to be increased on a year-on-year basis. Ideally, with this metric, we want to see the opposite effect with companies returning excess cash through share buyback. No surprises. ROIC then negative from 2018 to 2022 as they did make a loss. 2023 positive at 3%, but again, we do want to see 10% as a minimum just to give us faith management are able to effectively allocate their capital. 5% on a trailing 12 months, so it is moving in the right direction. Operating margin, again, no surprises here. It is moving in the right direction from negative to positive. Free cash flow margin over the last 3 years, very, very strong. We do want to see a minimum here of around 7%. 30% also looking attractive on a trailing 12-month basis for potential investors. Net debt to EBITDA, the earnings before interest, tax, depreciation, amortization. Remember, this does show us balance sheet strength, and this clearly shows us being the number of years it would take the company to pay off all of their debt net of cash on hand. It won't even take Palantir 1 day. So a phenomenally bulletproof balance sheet. So lots to like about this company. Let's jump into the valuation model. As always, if you do enjoy the content, value is being provided. Smash that like button, hit that subscribe and bell button so you're continually notified of these videos as they drop. Now, in terms of the free cash flow, we can see it here over the last few years. Average growth, negative 146. Again, because it goes to negative to positive, it does skew the data. We've got 3 rates here, low, medium, and high. We're going to start off the low at 20%. Now, if it does get that with the discount rate, we do get the present value of future free cash flows and terminal value. We add together with the cash, subtract total debt, get to equity value, divide by shares outstanding, and we get an intrinsic value now showing overvaluation. Now, a lot of people may argue that AD is in fact way too conservative, so we will move on to our medium, but this does imply downside of negative 12%. For those that believe 25% should be more accurate, then we can see an intrinsic value of $31, and we can in fact see here that would indicate upside of around 20%. Again, we have gone for those who may want to be a lot more optimistic at 30%. We can see intrinsic value of $42, and that would rightly be a upside of 65%. Now, as always, you can grab a copy of this model to run your own numbers through, put in your own numbers, whether it's a Palantir or others in your portfolio or on your watch list by clicking on that pinned comment below. Now, in today's episode, it really does come down to what you see over the next few years. We will go for the medium rate of 25% into the next slide, but again, bear in mind this valuation now is on a 25% free cash flow growth moving forward. Now, the intrinsic value then in today's episode is purely just that DCF valuation of $31. With the current price at $25.50, margin of safety. As always, now what we do on this channel, we start off with a 10% MOS level and we execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. If you believe that for Palantir, well, it is a buy up to $27.65, then we keep going till it's near the current trading price. And we can see in today's episode, it is around a 15%, not quite at a 20, so somewhere between 15 to 20%. Now again, remember that is based purely on a 25% moving forwards growth rate. In terms of Wall Street and their expectation, well, over the next 12 months, they in fact believe the share price will be around $23. So they do see downside of around 10%, although with Wall Street, as always, do take their estimations with a pinch of salt. If the share price continues to rise, they will revise that price going even higher, and the same if the share price does come down. So we do put this information within our analysis, but as always, do not rely on this. In terms of the share price, now at a 50 billion market cap, the company is trading around $23. It is marginally higher today. For those that believe it can get to a $1 trillion market cap, the price of this company would sit around $460. As always though, let us know your thoughts in the comments below. What sort of forward-looking growth rate do you envisage? What is your price target for this company? And whether or not you do see this as a strong buy now, maybe one on the watch list, or for whatever reason, let us know if this isn't one for your portfolio. As always, if you've enjoyed today's episode, smash that like button, hit that subscribe and bell button, let us know your thoughts below, and as always, we'll see you all on the next one.